Thanks, Nancy, and hi everyone. I think I noticed a few names on the call. So, for those that don't know me, I'm Dom, head of finance at Goodwill. Joined with Louis from our partners S&W, and we talked today about customs importing into the UK and sort of everything that goes alongside that. Um, Louis, I don't know if you want to give a brief intro.
Yep, sure. Thanks, Dom. So I'm Louis Stringer. I'm a senior manager in our Customs and International Trade team at S&W. S&W, we're a sort of a accountancy and tax professional services firm. We're based in London with offices regionally in the UK. And I advise basically on all matters to do with import and export into the UK and EU. And so, yeah, looking forward to discussing this with you today.
Great, thanks, Louis. Okay, so a little bit about Goodwill. So if you're a client of ours on this webinar, you might know this, but just to recap who we are. So over 25 years, 28th birthday this year for Goodwill, and we help businesses enter, grow and scale in the UK. So providing a full back office suite, whether that be incorporations and registrations for any licenses, all the way through to HR, payroll, finance, bookkeeping, sort of everything back office. And important to note, hence the reason for the joint webinar today with Louis, if there are complex cases out there, which there are particularly around tax and customs, then we do work with partners really closely just to bring all that together for our clients. So you probably noticed throughout the slides today, there are complex natures involved with customs and things to consider. So, there'll be a theme throughout the slides, but if anything sort of provokes any thought after today, do reach out to myself or Louis, and we'll have a collaborative approach to help you out there. So very briefly through the agenda, so I won't steal any of Louis' thunder through these, but it's just talking about really what is at stake for you guys. Often we see a lot of things left on the table in terms of exemptions or just best practice and being efficient with the process, all the way through to classification and commodity codes, helping things not getting stuck at the border essentially, and the types of taxes involved. A common question I get for new clients is, what can we claim back? What's the cost? So we're talking around, the import duty versus the import VAT. What else might there be involved? Duty deferment accounts, all that kind of good stuff. So hopefully we cover all of that briefly today in our sort of 20 minutes or so. So with that, I'll sort of next slide, please, Nancy, and I'll hand over to Louis. And yeah, off we go.
Yeah, thanks, Tom. So I think it's pretty sort of important to note as to kick off that the customs duty is one of the most overpaid taxes, just purely because of the nature of how it is paid. So nearly all customs declarations are declared on a business's behalf by a customs agent. It's not necessarily their job to do things compliantly or correctly. They just want to get things into the country across borders and get paid for it. So for that reason, so that's why we see a lot of sort of businesses come to us and say we think we've overpaid duties, or we do like a deep dive into a company's data and we see that they've overpaid duties or they've not been doing things compliantly. So we're looking at this both from a compliance point of view and from a sort of an optimization point of view. Um, so there's sort of big opportunities as well as quite a lot of important things you need to make sure that you're aware of when importing into the UK. Consequences. So on that, consequences of getting it wrong. Undetected overpayments just hit straight bottom line. It's a cost to import, it's a cost to pay duty. We'll come on to the difference between import VAT and duty in a second, but it's a real cost. And the best way to look at a customs declaration is as like an individual tax return. So every customs declaration you have declared in your name, to treat it as like the equivalent of like a VAT return, because that forms the legal basis for any taxes paid, and that forms the tax point as well. And any errors that a potential audit would pick up, they would hypothetically ask for a demand of any potentially underpaid import VAT and duty. So that can again just become like a not only sort of an administrative burden going through the audit process, but then also a real cost. There's also, of course, the potential to disrupt goods flows, and then let customers down.
And Louis, if I jump in with a question
Yeah, of
there,
course.
so would I be right in saying that practically it's not ourselves that do customs declarations, it's maybe the freight forwarder, whoever they use, like FedEx, DPD, whoever it might be?
Exactly.
But
Yeah. So
it's still ourselves that are legally liable. So we need to be challenging those guys, making sure what they are putting on declarations is correct and accurate.
exactly, and it kind of the burden of proof comes down to the importer. There's no sort of argument in the hypothetical case in audit to say this is what our customs agent declared. We didn't tell them to do this. You're obliged as the UK importer to instruct the customs agent and then also to do your due diligence post import to make sure that the customs declaration accurately reflects what has actually been imported.
Okay, thanks. Yeah, I would imagine that's a point missed by a lot of people. So
Yeah,
yeah, really
yeah, and it's
important
a
one.
it's sort of a common not argument, but if a business was likely to get imported, they'd audited, sorry, they'd say, we don't do the declaration ourselves. We sort of we contract it out to a third party, and that doesn't really act as evidence or argument from HMRC's perspective.
Thanks.
Cool. So I think it's quite important at this point just to sort of clarify the difference between what we mean by import tax, customs duty, and import VAT. So import tax is just a generic phrase to indicate sort of the revenue generated by HMRC and the money paid by a business when importing goods into the UK. And then there's two, broadly speaking, there's two of these that we're going to touch on today, and that is customs duty. So customs duty is levied as a percentage. In the UK, it's 0 to 12% for most goods, with a couple of sort of additional duty rates, but we won't really touch too much on those today. And it's paid either straight at the point of import, or postponed using like a deferment account, or suspended using a customs procedure such as inward processing or customs warehousing. Important to note at this point that, so unlike we're about to see with import VAT, it's not recoverable in any way. So a lot of import VAT can be recovered through the VAT return, but customs duty, unless you can put forward a case for reclaiming it, is not recoverable. It's just a cost at the point of import. Unlike VAT, which is levied at a flat rate, 20% for the moment anyway, until the 26th maybe, on the value of the imported goods into the UK. So, and this is either paid upfront like customs duty, or it's you can use something called postponed import VAT accounting, which essentially just provides you with a cash flow benefit. So there's no upfront payments at the point of import, and then it just becomes a sort of an accounting exercise through the VAT return to recover it.
And a question on that one for me as well. So I see a lot of clients where they instruct a freight forwarder to move the goods for them, and they instruct PIVA, or maybe they don't necessarily,
Yeah.
but that freight forwarder doesn't use the PIVA process, and therefore the import that's payable when the goods come into the country, and they get issued with a C79, which is sort of in my head, the old school way of doing it, and then they
Yeah.
recover it on the VAT return. Is there any benefit to C79s, or is it a bit of a no-brainer to use PIVA now, and therefore should all clients be telling their freight forwarders, please use PIVA for me?
Yeah, it really is a no-brainer. I think just because that, I mean, especially, with 20% of the shipments can be quite sizable. You don't really want to be losing that cash flow benefit if it's there. So I won't go into sort of the politics around at the moment around import about postponing import VAT accounting and the sort of the misuse of it. But if it's available to you and you're eligible to use it, I would definitely say to utilize it, because it's 20% cash flow benefit for X amount of months.
Yeah, and I think that'd be one of the key takeaways for guys on this webinar because I'm looking down the names and I personally see VAT returns for some of you guys where C79s are still in use. So, I mean, it may be small, so it may not be too much of an issue. But like Louis said, if the sort of import is a large value, that's just going to hurt cash flow.
Yeah.
So you definitely want to be talking to your freight forwarders and giving them the information they need, which is usually a VAT and EORI number, and getting PIVA or postponed import VAT accounting in action for sure.
Yeah, and just an important note on that, you don't necessarily need to like apply for PIVA. It's not like an authorization. It's just a case of informing your customs agent that you want to use it.
Thank you.
Slide, please. Yeah, so we're going to sort of touch mainly on the factors that impact how much duty and tax you pay on import into the UK today. So basically, there are these three factors that determine how much duty is paid, and that's classification, customs valuation, and the origin of the goods and any availability of FTAs. And we're going to touch on each of these in a bit more detail in the next sort of 10, 15 minutes. So I won't talk too much about them right now. But essentially, if any of these three sort of factors or um, factors are incorrect, there's likely to be sort of a over or under payment of duties and as such like a non-compliance with UK legislation. So it's really important that we get all three of these right. So if we could move to the next slide. So the first one is what is classification? I think the word what there is really sort of the key word for me when I try to simplify this. It's exactly what is the good I'm importing. So, and customs classification is just the process for assigning all of these products a specific commodity code or HS code as per the sort of the importing jurisdiction's tariff. So the main reason this matters is because the commodity codes determine the duty rates. And so, as we saw earlier, that the duty rates range from 0 to 12%. This is purely driven by that commodity code. There's something like 5,000 commodity codes, maybe more. I don't know them off the top of my head yet. We're getting there. And so like that kind of in itself explains the complexity around classification. And we'll sort of touch on a few examples in a bit. But it was really important just to get that the first piece nailed, which is the commodity code for your goods. And the sort of the key tips and considerations here are what does my product do? What's like the description of the composition and what's its intended use? And that intended use becomes like quite important when you essentially have like an option of two commodity codes that it could be. So you need to think about the function rather than just is it steel or is it a part that goes into a car? You know, there's these considerations where it could potentially fall into either or, but you want to sort of get it right so that you're A, being as efficient as possible, B, not like putting a target on your head for an audit. If we could just jump to the next slide. So when we'll look at in a bit more detail at commodity code, but I just thought I'd point out that when you're operating in a number of jurisdictions, it's important to have your commodity code sorted for all jurisdictions that you operate in because they're not always the same. So if we use this example on the left here, we've got basically a commodity code for sort of other articles of plastic. It's a nice generic one. But as you say, as you'll see, the sort of the global 6-digit commodity code, which is standardized, is the same for all four jurisdictions we've shown there, but there's three different variations within those. So say for example you're exporting something out of the US and you're using the commodity code that you think it is in the US, it doesn't necessarily mean that it's going to be the commodity code for import into the UK. And that's really, really important thing to sort of get to grips with because we have quite a few clients come to us. I've got an update that's popped up. Quite a few clients come to us and say, yeah, we've got our commodity code that comes from our sort of Chinese supplier. They've provided us with this commodity code, and we look at it, and that commodity code doesn't actually exist in the UK because the suppliers provided them with a Chinese export commodity code. So really, really important just to double check, triple check, get a second opinion on all of on your classifications, just in case there's any way we can A, optimize it and B, sort of bulletproof it from a compliance point of view. So if we just call them next slide. So this is like an example of a commodity code. This is a pharmaceutical product. So what you've got there is this is how you sort of break down a 10-digit commodity code. So you've got the HS chapter, which is the chapter you can sort of look up to start finding the commodity code in a country's tariff. And then it starts to be broken down into essentially sort of like logical categories until you get to the final classification numbers, which you come in sort of more specific areas. And and a very important thing to note is that exports, you only need an 8-digit commodity code, and imports, you need a full 10-digit commodity code. So there's that point again about making sure that you're aligning and not just adding 00 onto the end of your export commodity code. You really need to double check that import commodity code is completely correct. So that was the sort of the what. you know, classifications, what we call the what. Now we're going to look at sort of customs valuation. So these are the WTO customs valuation method. So these are used in every country that is part of the World Trade Organization, and you'll see that there's six basically. So you need to you need when you're trying to work out your customs valuation, you need to go through the methods in sequential order. So if you can't use one, you must use two, and so on and so forth. And so, I mean, 95% of shipments will be transaction value because there will be a sale. But it's when you've got things like consignment movements where you're moving your own goods with no transaction between two entities that this becomes sort of particularly important to get right because you need to come up with a fair and arm's length value for your goods. You can't just give them like an intangible €10 valuation. You need to come up with a proper valuation for them. I won't go into the detail of all of them because it's a bit technical. We've only got 10 minutes left, but
Well, I guess a takeaway for our clients as well on the webinar is I see the most common scenario is where you have a mother company overseas with a UK subsidiary. The UK subsidiary sells to a UK customer, where they're buying the goods from the parent or the mother company overseas. So, like you said there, Louis, it's that valuation, that intercompany um, transaction price is important to get right and not to make it artificial or manipulated.
Exactly,
Would
yeah,
it be fair to say, I mean, just tell me if this is wrong, would it be fair to say using the cost price is fair, so it's a break even in the mother company, or should we be adding a markup onto that?
well, yeah. So this is where we come into sort of like transfer pricing and customs into place. So
Mhm.
if you've got if you're buying from a parent, you need to show that you ideally, and you're using the transaction value, you ideally need to show that you've sort of benchmarked the margin that you're using. So you can hypothetically apply like a lower customs value than the value you're selling in the UK. If you're buying it from a parent to then sell into the UK, for example, but you can't just like use the cost price in the
Yeah,
exporting country. You need to show that there's been like an element of um, markup and arm's length sort of benchmarking applied.
yeah. Okay. And yeah, I guess takeaway for this call as well is if that's provoked thought in people, reach out because I should imagine that's probably the most common scenario for sort of Goodwill clients or prospect clients that want to enter the UK with a subsidiary model. That's going to be probably the biggest thing to think about, making sure that's done properly and some evidence and considerations put around that
Yeah,
intercompany sale.
exactly. And this also becomes like an optimization and efficiency point. So we're doing a lot of work around how can we sort of working with our transfer pricing team, how can we adjust the transfer price to show a fair margin, but also have the customs value hypothetically
Yeah,
lower. So it's kind of
yeah,
it's
perfect.
again it's the carrot and the stick.
Perfect. Thank you.
Just move on to the next slide. So yeah, so the customs value sort of legally can't just be the value of the goods. So the best and there are certain things that need to be added to the customs value to create a compliant customs value. So the one we typically when we've been doing a lot of HMRC audits recently, the one we typically see businesses fall down on is not declaring the freight value. So a lot of these are important to be aware of, but the freight charges and insurance premiums on sort of high seas freight are the ones that HMRC are picking up on, just because it's the easiest target for them. It's very hard for them to delve into documents and find is there a patent trademark involved there, but it's very easy for them to see there's been no freight charges applied to the customs value and raise that. I won't go into too much detail on these in the interest of time. Um, so if we could just go to the next slide. And finally, so we've had the classification, valuation, and now we've got country of origin. So the country of origin is basically the nationality of the product, and kind of you can kind of see it like a passport for a goods for a product or a good. So essentially, the reason origin is so important at the moment is because you can benefit from free trade agreements depending on where the good originates. Um, and this is really, really useful for businesses trading, like particularly across EU and UK. So, and the benefits are like especially for retailers where they're looking at 12% duty. The benefits are just are there to make the most of them essentially. If we could go on to the next slide, we'll go into a bit more detail on origin. Yeah. So preferential origin refers to sort of the criteria that determine the origin of the goods, and these are sort of driven by what's called rules of origin, which are individual rules that determine the origin depending on each free trade agreement. And so I think the key point here is that there needs to be the proof of the origin before the importation happens, and you must submit evidence upon request. So whilst the benefits are there, we need to make sure that we are basically evidencing that we can provide preferential origin for every import. And this is sort of something we're doing quite a lot at the moment. And it just everything just kind of comes back to that point around freight forwarders being so embedded into people's operations. So if we look at an example of an EU movement, the main way you evidence origin is to have a statement on the invoice. And we see so many businesses when we look at their customs data, they've not been applying preferential origin to any of their imports, but they've had this preference statement on the invoice the whole time. So they've been losing out on this chunk of duty savings for X amount of years. And it's this come in it just comes back to this like making sure that you're aware of what your customs agent is declaring on your behalf. And so, sort of finally, I just thought I'd touch on sort of the customs establishment risks for overseas entities. So, um, to be established for customs purposes in the UK, the law basically says that you need to have a UK incorporated entity, so a limited company, or a permanent place of business where you have customs related activities and sort of we see that as a supply chain staff or finance staff where that's carried out. So it's not enough to be VAT registered to confer UK customs establishment, which is very important to note. And if you are not customs established in the UK, cannot use direct representation. So you need to use an indirect rep, which means the customs agent is joint and severally liable for all of the contents of the customs declarations that you're declaring. And this comes with additional costs and also essentially a lot of freight forwarders now are just outright refusing to. So whilst it comes up with, other sort of nexus issues and things like that, we always recommend that there's some form of entity to import into, use a UK limited to import, just so you're not um, basically relying on a customs agent that may just one day say, no, we're not going to do it because you're not established in the UK. There's also sort of the additional benefits of being able to use UK reliefs when you're established for customs purposes. So, say for example, you import into the UK, you manufacture something and you re-export it, you can use something called inward processing to completely defer any duty and import VAT payments in the UK. I'm sure you've got
Okay.
something to add there, Dom, on the
Yeah,
sort of
definitely.
this.
I was
We've
going
been
to
seeing
say
quite a
that.
bit of this.
Yeah, we see this quite a lot, and it's a common question. It's actually the driver a lot of the time for setting up a UK subsidiary, rather than a branch or operating directly from the overseas mother company. And again, I know there's a few people on the call from experience I've spoken to where they're looking to make that shift. So they might be using the mother company right now, but the subsidiary is being set up or has been set up. So I just urge you again to maybe take this as a bit of inspiration to look at your setup. Are you still importing from the mother company, potentially missing out some exemptions or not being as efficient, and sort of making that switch so that mother company is selling to the UK subsidiary, we can work out that internal transfer pricing approach, and then the UK subsidiary becomes the importer, takes advantage of these reliefs, these efficiencies, and then sells on. And it also allows, the mother company to deregister for UK VAT, cancel the EORI number, rather than running it in both entities. So again, any questions around that spark some thought, reach out to me. Maybe it's a breakout session myself and Louis that we have just to have a bit of a strategy and a plan around it.
Absolutely. Always happy to set something up to discuss high level.